Boeing once again surprised the world with its financial results, reporting huge losses of $5.4 billion for the third quarter of 2025 at the end of October. It would seem that such a figure should have dismayed shareholders and analysts. However, this week could be the best for the American aviation giant in the last 6 years. Why? The answer lies in geopolitics, trade wars, and a multi-billion-dollar deal with China that could radically change the company's fate. Boeing's third quarter financial results look daunting. The company reported a loss of $7.47 per share, which is significantly worse than the consensus forecast of analysts, who expected a loss of $4.59 per share. The main factor behind this failure was a $4.9 billion write-off related to another delay in the Boeing 777X program, the flagship wide-body airliner of the new generation. However, upon closer inspection, the situation does not seem so hopeless. Revenue grew 30% to $23.3 billion, exceeding market expectations. Even more significant is that Boeing reported positive free cash flow for the first time in nearly 2 years, at $238 million. This indicates that the company has finally begun to generate more cash than it consumes in its day-to-day operations. In the first 9 months of the year, Boeing delivered 440 aircraft, compared to 291 in the same period last year. This figure is particularly important because airlines pay most of the price of an aircraft upon delivery, rather than at the time of order. Accelerating the pace of deliveries is key to stopping the cash outflow, which has totaled nearly $17 billion since the beginning of 2024. The Boeing 777X program has become the embodiment of the difficulties facing the American aviation industry. Initially unveiled in 2013, this airliner was conceived as the successor to the iconic Boeing 777 and a direct competitor to the European Airbus A350. But the development process turned into a long series of delays and cost overruns. The 777X made its first flight almost 6 years ago, but the aircraft has still not received certification from aviation regulators. Boeing has now announced that deliveries will be delayed until 2027, another year later than previously planned. The total cost of the project has already reached nearly $15 billion, making the 777X one of the most expensive programs in the company's history. CEO Kelly Ortberg has openly expressed his dissatisfaction with the latest delay, but noted that the aircraft has consistently performed well in flight tests. According to him, new requirements from the U.S. Federal Aviation Administration require additional time for preparatory analysis and procedures. For Boeing, this shift means not only direct financial costs, but also the risk of losing a key segment of wide-body aircraft to a European competitor. As global demand for long-haul transportation grows, the A350 is strengthening its market position, leaving Boeing in the role of a catch-up player. And it is against the backdrop of these financial miscalculations that events are unfolding that could radically affect the future trajectory. A contract worth tens of billions of dollars, which could become the largest in the manufacturer's history. The potential deal takes on particular significance against the backdrop of U.S.-China relations. Since 2018, when trade tensions between the countries reached their peak, Boeing has effectively lost access to the Chinese market. Over the past 7 years, the company has made only a few dozen deliveries to China, with the lion's share going to cargo aircraft or deliveries to Hong Kong's Cathay Pacific. By comparison, in the decade prior to 2018, Boeing delivered over 1,000 airliners to Chinese customers. China remains one of the world's most important aviation markets thanks to the rapid growth of passenger traffic. According to Boeing's own estimates, the country's passenger aircraft fleet will double in the next 20 years, and Chinese airlines intend to purchase 9,000 new aircraft. Boeing's departure from the Chinese market was not caused by safety or product quality issues. According to analysts, the reason is 100% political. As Richard Abulafia, managing director of consulting firm Aerodynamic Advisory, points out, Boeing has literally found itself caught in the crossfire of the trade confrontation between the U.S. and China. Against this backdrop, negotiations on the possible delivery of 500 aircraft are turning from a routine commercial deal into a significant diplomatic tool. Contracts of this magnitude are usually announced at meetings between the leaders of both countries. It is not surprising that the conclusion of the negotiations may be timed to coincide with the meeting between President Donald Trump and Chinese President Xi Jinping. Trump has already shown a willingness to use Boeing sales as a diplomatic lever. Upon returning to the White House, he actively highlighted large aircraft orders from Qatar and Uzbekistan. The announcement of a major agreement with China in the context of trade agreements is entirely consistent with this line of behavior. Boeing CEO Kelly Ortberg publicly thanked the administration and the president for their assistance in securing contracts. Obviously, the administration and the president are doing a great job helping us get orders in the market, he said in an interview with CNBC. While Boeing was dealing with the aftermath of the 737 MAX crashes and the fallout from trade disputes, its key rival Airbus significantly strengthened its position in China. Since 2019, when Chinese regulators were the first to ground the 737 MAX after 2 tragic accidents, the European manufacturer has effectively taken the lead in sales and deliveries in the Chinese market. Airbus's triumph in China clearly shows the high price Boeing has paid for its technical failures and political clashes. While the American company was losing ground, the Europeans were systematically building trust with Chinese airlines and regulatory authorities. It is noteworthy that, according to unverified information, Airbus is also discussing with China the possible delivery of up to 500 aircraft. This testifies to the scale and capacity of the Chinese market, which is sufficient for large orders from both manufacturers, but Boeing needs to act quickly in order not to lose its share completely. Despite the difficulties with the 737X, Boeing is showing signs of stabilization in its core production. In October, the U.S. Federal Aviation Administration lifted the restriction that had kept the production rate of the 737 MAX at 38 aircraft per month. The company now has the opportunity to gradually increase production to 42 aircraft per month. This is a significant milestone for Boeing, given that the 737 MAX remains the manufacturer's most sought-after product. The increase in production rates not only means an increase in revenue, but also indicates a return of confidence in the quality of Boeing products among regulators. CEO Ortberg notes significant progress in operational processes. According to him, the volume of non-sequential work on the 737 line has been reduced by 75%, and across all programs by 60%. This result indicates an improvement in the quality of production operations and a reduction in rework costs. While Boeing's civil division is experiencing a period of turbulence, the company's defense segment remains relatively stable. In the third quarter, the Defense, Space, and Security Division's revenue reached $6.9 billion with an operating margin of 1.7%. The defense segment's order backlog increased to $76 billion, with approximately 20% coming from customers outside the United States. This is important for diversifying risk and reducing dependence on the political agenda of any one country. During the reporting period, the division received a contract from the U.S. Space Force to develop strategic satellite communications capabilities and entered into a partnership with the Royal Australian Air Force to demonstrate the autonomous, operational capabilities of the MQ-28 Ghost-Bat unmanned aerial vehicle. Boeing's third business segment, Global Services, continues to demonstrate outstanding profitability. In the third quarter, this division generated $5.4 billion in revenue with an operating margin of 17.5%. For the company, this is a stable anchor of income that smooths out fluctuations in serial production and helps to plan cash flows more predictably. The high profitability is due to the nature of the business. Servicing aircraft that have already been delivered requires significantly less capital investment than manufacturing them, while providing a steady stream of revenue over decades of fleet operation. The service portfolio includes maintenance and repair, MRO, spare parts supply, aircraft upgrades and modifications, digital solutions for fleet management and predictive maintenance, as well as staff training and operation support. This applied proximity to the customer increases airline loyalty and reduces the sensitivity of the business to cycles of demand for new aircraft. During the reporting period, the division received a contract from the U.S. Navy to repair landing gear struts for the FA-18, confirming Boeing's expertise in complex military equipment work and expanding its long-term order base. In addition, the company announced a strategic cooperation agreement. Details have not yet been disclosed, which is likely aimed at expanding its range of service offerings and deepening partnerships with the key customers. Taken together, these steps strengthen the position of the service business as one of the main drivers of margin and sustainability for the entire group. The coming months will be decisive for Boeing. The company needs to finalize negotiations with China, avoid further delays in the 777X program, and continue to ramp up production of the 737 MAX. Each of these areas is a serious management challenge in itself. Although the deal with China looks promising, it is still largely determined by the politics between the two countries. Experience shows that such agreements can fall apart due to changes in the geopolitical situation. Experts also point out that a significant portion of the new Chinese orders could actually have been placed over the past 9 years but were not publicized due to trade tensions. The 777X program requires certification, a process that has proven to be much more complex and time-consuming than initially expected. Each additional delay not only inflates costs but also strengthens Airbus's position in the rapidly growing wide-body aircraft market. Behind all these metrics and programs are people, Boeing employees who create some of the most complex engineering systems in the world every day. The company is undergoing a major transformation under the leadership of Kelly Ortberg, an aerospace industry veteran who returned from retirement to lead Boeing in August 2024. Ortberg is focused on stabilizing the complex supply chain and the rhythm of production lines. His mission is not only to eliminate technical and financial problems, but also to rebuild a culture of safety and quality that was severely damaged during the crisis surrounding the 737 MAX. In his address to the team, Ortberg acknowledges that there is still much work to be done to advance our development programs, especially commercial projects and certification, while emphasizing that he is proud of how the team is consolidating for positive change within the company. Boeing's experience in recent years clearly demonstrates how closely technical, financial, and political factors are intertwined in modern business. The company, which for decades has been a symbol of U.S. technological leadership, has faced a systemic crisis whose causes go far beyond reporting metrics. These include management decisions, risk culture, supply chain resilience, and the quality of internal controls. Reputational capital proved to be as vulnerable a resource as cash flow, and its restoration requires time and consistency. The tragedies involving the 737 MAX showed what happens when the focus shifts toward reducing time and costs while simultaneously weakening attention to safety. This revealed the costs of insufficient coordination between development, certification, and user training, as well as the need for strong independent quality control mechanisms. The main lesson is simple. Prioritizing safety is not a competitor to the goal of profitability, but a necessary condition for it. Otherwise, financial gains turn into much higher risks and losses. Trade conflicts have revealed the vulnerability of even the largest corporations to geopolitics. Access to key markets, export regimes, mutual recognition of certifications, and political signals can instantly change a commercial trajectory. Against this backdrop, the protracted delays on the 777X have further highlighted the complexity of managing mega projects in an environment of changing regulatory requirements. The cost of system integration, verification, and evidence base for regulators is increasing. The overall conclusion is that sustainability in aircraft manufacturing is built on a culture of safety, transparent management, engineering discipline, and market diversification. Only this combination makes growth sustainable and success reproducible. Today, Boeing is at a point where the consequences of past miscalculations collide with the prospects of tomorrow. The huge losses in the third quarter clearly show the price of previous decisions, while a possible contract with China opens a window of opportunity. The key question is whether the company will be able to learn the right lessons from the crisis it has experienced and turn them into the basis for a sustainable turnaround. For a broad audience, the story of Boeing is a reminder of how rapidly even the world's largest corporations can change course. In a reality where technology, politics, and economics are closely intertwined, success is determined not only by product quality, but also by the ability to navigate a complex geopolitical environment, build relationships with regulators and partners, and respond to external signals in a timely manner. Only time will tell whether this week will truly be the best for Boeing in the last 6 years. It is already clear that the company is on the verge of significant change. How effectively it takes advantage of the opportunities that are opening up, from the recovery of key markets to the acceleration of certification processes and the stabilization of supplies, will determine not only its own trajectory but also the future of the entire American aviation industry. Ultimately, the Boeing paradox, losses amid growing optimism, reflects a broader feature of the modern economy, in which short-term financial results can diverge sharply from long-term potential. For investors, analysts, and observers, this is a signal. It is important to evaluate the company based on the big picture, the dynamics of its order portfolio, the quality of its execution, strategic risks, and operational discipline, and not just on the numbers in the latest quarterly report.